So let's take a practical example of how we deal with consolidation and giving the question an associate. All right. How do we solve a question like this? Now, the first thing you do in solving any console question is to go and read the requirement. Read the requirement because you have basically 30 minutes to finish this question. So you read the requirement. You are asked to prepare consolidated P&L and also do consolidated statement of financial position. Most importantly, what you look out for in the requirement is the date. So look at this. We are preparing this thing at the 31st December 2020. Now, always check that thing with the financial statement that was given that in the question. You realize that it should be the same. So you realize that it is 2020. Good. That is the first thing. Second is to skim through the figures that are given you here. So you have revenue, cost of sales, gross profit, distribution, and finance costs, just to familiarize yourself with what is there. All right. So gain or loss on revaluation, gain on revaluation is here for that of the parent. Good. So you familiarize yourself with that. You do the same thing for the balance sheet. Look at the things that are in the balance sheet. Let's look at them. All right. Just look at them. Okay. Then you go and read the notes. Now, when you are reading the notes, the first thing you are looking out for is the ownership structure. Because remember, if you look at the videos that we've done on consolidation, there are 4 things basically you are looking at. The ownership, where you do acquisition date and the control. Then you are looking at fair value of net assets, which will help you to do your workings too. Goodwill workings 3, NCI workings 4. Then you choose to add your workings 5 to do your balance sheet. Now, so with what you have here, the first thing that you are doing is to read for your control, because you are going to start up with some workings, which is compulsory according to IFRS 3. So workings 1, you are going to do a group structure. So you are reading the information that you are given just to be able to draw your group structure. So you have to read to the end. All right. You have to read to the end. So let's start. Additional information. On September 1st, 2020, Papa Limited acquired 80% of the equity of Susuka Limited. All right. The consideration consisted of 2 elements: share for share exchange of 3 shares in Papa Limited for every 5 shares acquired in Susuka, and at the same time issue a 100 Ghana cedi 6% loan note for every 500 acquired. All right. Now watch this. You have to continue reading. It says that the issue of share has not been recorded, but the issue of the loan note has been recorded. So it means that you don't create any additional liability for the loan note. It has already been recorded. Because when I do it, I'll show you what you would have done if it has not been recorded. All right. So it means the only thing we should focus on recording is the share for share exchange. At the date of the acquisition, the shares in Papa Limited had a market value of 5 cedi each, and the share in Susuka had a stock market price of this. So we will do it, and you will see how we will do it, because you will use the parent own to determine purchase consideration. You will use the subsidiaries own to determine the NCI. Good. Papa had earlier on July acquired 2.4 million shares in Obra. So that is another one at a stock price of 1.50. So that is a share purchase, and the price has also been given to you. So here alone, I can draw my ownership thing, all right, because per what I've read, there is Papa who acquired, what is the name? Susuka. Okay. Now, what is the percentage he acquired? He said he acquired 80%. So that is it. But when did he acquire it? September 1, 2020. You have to do that, because these are the things that I have taught in the very first video, 2020. What is that period to the reporting date? If I check, reporting date is December 2020. If I bought it first, it means I have first September, October, November, and what? December. That makes it how many months? 4 months. So I had a 4-month subsidiary. Good. So you have to take note of that. Then we are told that he also acquired another guy earlier before that which Obra, that's the name, Obra. What is the percentage he acquired? He acquired 2.4 of the shares in Obra, 2.4 million. But what is the shares in Obra? This is where you find the shares in Obra. Come to Obra and go to the stated capital of the shares. It is 6,000 and 6,000. So this is it. It is in millions, all right? But everyone is 1 Ghana cedi. So it means this one divided by 6,000 all over, divided by 1. So the 6,000 here is 1. And any number divided by 1 is the number. So assuming this side was 0.2, you do 6,000 divided by 0.2. All right. Assuming it is 5, you do divided by 5. Take note of that. So what percentage would that give me? So I have 2.4 million over 6. That is 40%. And that makes it an associate because it is not more than 50%. But what is the period? Because the date we are told this thing happened was somewhere June, right? Say July. So you bought this one in July 1, 2020. That period to the period we are preparing the financial statement is what? 6 months. Is that not it? So you note that one down. So this is your note 1. But sometimes you have to further read because there may be some acquisitions. All right, but it says the date of the acquisition, the fair value of the net asset. This is for your workings too. The group policy is to value or revalue all this. Okay, this is additional. It has nothing to do with your ownership. Sale from Susukan. This is for PAP. All right, so we will look at that. In December, this one too is another PAP. It says that Papa investment include available for sale. Papa's investment include available for sale. That is for the parent. So we will look at it in the workings 5. All right, so that is that. So anything concerning the parent. Now we come to here. Workings 2. IFRS 3 tells us to do the fair value of the net asset of the subsidiary. Fair value of net asset of subsidiary. And this, our subsidiary is only Susuka because the other one is not a subsidiary, it's an associate. So you do that. What is the fair value of the asset at acquisition, at reporting, and post-acquisition? Please, I've told you that since the figures are in 3 zeros, all right, all the time, make sure to say workings, all workings are in, all right, 3 zeros. Okay. So, and when you are doing this, remember the structure we are using for this side is always E is equal to A minus L. This is accounting equation. Whenever somebody is buying somebody, this is the one that they buy. All right. So, and if they didn't do something well here, you come back and do it. That is what we call the fair value adjustment. So let's start. Go to the E part. Have you seen the E part? Equity part. So let's start with the equity part. We have equity shares. Equity share capital. How much is that? So this is our subsidiary, right? So we have 5,000, which means there is no movement. Oh, pen. There is no movement. We do movement, this one minus this one, to know there is movement. After that, what do you see? Revaluation, land revaluation is about, there is nothing here, so it means we won't do anything. Then the next one is what? Equity reserve. So we have other equity reserve. So the other equity reserve, look at it. That one too, there is nothing there, so we shouldn't even go there at all. So we won't do anything there. Okay, there is nothing there for the subsidiary. This workings too is mainly for the subsidiary. Then we have retained earnings, don't we? So here, retained earnings. The retained earnings, the figure that you see in the balance sheets are prepared at the end of the period. So we call it the reporting date figures. So at reporting is what? 4,500. But what is the acquisition? We don't know. But we know. How do we know? Because if you know this one is your reporting, and you have also been given a P&L, this is your P&L. So it means that before you bought the company, this figure, 3,900, is always inside this figure, because when we say retained earnings means accumulated profits. And I've told you that whenever you have a question where this thing is a mid-year, it is between the periods, not 1 year, 2 years is there. It means you must start from this side. So it tells you that you can see your post-acquisition. Now, the figure here is 3,900. 3,900. And they didn't tell you anything unless they told you that there is a intra-group loan or something inside what you are doing. But if there is no intra-group loan, then fine. All right. So you have 4 months, meaning that post-acquisition is 4 months, 4 over 12, multiplied by the profits. This profit. This is the profit for the whole year. Where is it? P&L is prepared for 12 months. So this figure, 3,900, you have to find the post-acquisition. And we do this anytime the acquisition is mid-year, but within the year. So you have 4 over 12 multiplied by 3,900, meaning that your post-acquisition here is 1,003. And if here is 1,003, then what will be the figure here? So if at reporting minus at acquisition will give you this, then it means that if you less 4,500, here is supposed to be 3,200. Straight up, because that means that you are doing, what do we call it? 4,500. So if you wanted to know, it's 4,500 minus the 1,003. That's the only way you can get this post acquisition, and that is what you have. So basically, that is that. Easy peasy. That is that. Now, when you are done with this, you are done with your E part of everything. Now, let's go to the A part. Is there any adjustment things they did which we need to take good note of? Is there any adjustment thing that they did? So go and check for your PAPs. Anything concerning the subsidiary must come. All right. So that is that. They said that at the date of acquisition, the fair value of Susukan. So it means we need to do it in Susukan. So there is something called fair value. So you have to do fair value adjustment. They said that the fair value of the thing, because everything must be at fair value, but they said that the fair value were equal to the carrying amount. Hallelujah. With the exception of property. That means that one wasn't done at fair value, which had a fair value of 1.2 below, which means that, you see, what they recorded was more, because if the fair value was below, it means what we recorded was more. So fair value of 1.2 below the carrying amount. So fair value adjustment will be minus 1.2. Minus 1.2. If it was above, we will leave it open because you had to add it back. This one is below. So it means that what the figure that they did was higher than the fair value. So we need to subtract it. All right. So that is that. Fair value adjustment. Good. And it is a property. Property. All right. Now they said that 1.2 over the carrying amount. This would lead to a reduction in the depreciation. Of course, they are telling you that fair value adjustment depreciation. Since you overcharged, the depreciation too was overcharged. So we need to reduce. So they are telling us to reduce the depreciation, excess depreciation. So it means we overcharge depreciation. We need to cancel out the overcharge depreciation. So instead of canceling, it will be outside the bracket, because depreciation was deducted. To cancel what was deducted, you need to add back. All right. So here will be 50. All right. This is different from your usual position where this one is rather open and this one is rather put into bracket, because this one, it was below. If it is above, this one will be open, then this side will rather be in the bracket. Okay, so that is that. And this was not done in the financial statement, so we have done it. Good. So is there any other thing? Check for any PAP or anything. Look at this next statement. Policy of the group is to revalue all properties to current value. And on 31st December 2020, the value of Susukan's property was unchanged from its actual value. That is why this place is the same and this place is the same. It was unchanged. But there is a land element of the property that had increased in value by 500 cedis. as shown in the other comprehensive income. So let's go to the other comprehensive income. Where is the 500 Ghana cedis? So this is where the 500 Ghana cedis is. That 500 Ghana cedis is in the book of the Papa. All right. So where are we now? All right. So this is it. But the land elements, all right, are seen in the other comprehensive income. So that one is in Papa's book. There is revaluation that has been done, and we will do anything of it inside Papa the workings 5 if there is anything to be done at all. So it increased by value 500. Okay. So unless they are telling us that that property was in the books of that particular what do we call it, subsidiary, but here this is it. It is land element of Papa's property, so we will do it in Papa's working. That will be workings 5. All right, so that is that. But there is a sale from Susuka, so that one will bring about PAP, provision for unrealized profit, since Susuka is the one that is selling. All right, so sale from Susuka to Papa throughout the year was 12 million. Susuka made a markup. How can you give a markup when the thing is about a sale? So these are things you need to understand. How can you give a markup? Because markup is done on cost, but margin is done on sale. But here he says that he sales from Susuka, which means Susuka sold the thing to Papa for 12 million. That is selling price. Susuka made a markup on 25% on this. It should be margin of 25% on this, which means that in this case, we need to convert markup to margin. And so this is one of the things I will change an ink for. So it means it will be 25 over what? 125. We are changing it to margin. All right. So if you have markup, you are changing to margin. You will just add the numerator to 100. But if it is margin to markup, it is the numerator, which is usually 100, minus the the denominator, which is usually 100, minus the numerator. So we are going to multiply this percentage by the quantity of the inventory that is still in stock at the end of the year, the part they have not sold. So he said Papa had 2 million of this inventory at a cost to Papa. Of course, that is as a selling price to Susuka. All right. So he had 2 million of those inventory that has been supplied in the post acquisition, still in stock by the end of the period. So you multiply this thing by 2 million Ghana cedis. So if you multiply 25, 2 million, that is giving me 400. So PAP we subtract. Oh, the pen is slowing. 400. So that is that. All right. In December, Papa sold to Obra. That is the parent. That's nothing to do with Susuka. Papa, this one too has nothing to do with Susuka. Then we have Papa again, nothing to do with Susuka. So this one too is for goodwill. Then it means we can close the balances here. So now let's look at the balances. We have 5,000 plus 3,200 plus 1,200. Here is 9,400. Minus, sorry. See, so also be careful. Minus 1,200 rather. So here is actually 7,000. Then this side also, you have 5,000 plus 4,500 minus 1,002 plus 50 minus 400. We have 7950. So here should be 950. You can confirm it. All right. So that is that. Workings 3. Immediately you finish your workings 3, go and start your balance sheet. Do your balance sheet first. Even though the question says do P&L first. Do your balance sheet first. So leave one full space for the P&L and go to the next space and do your balance sheet. Or you can actually do your balance sheet after that, then you go and do your P&L. So just number it well that II is the one for the balance sheet. So goodwill, we will start with the purchase consideration. So how much was the entity purchased for? It was purchased using two means, right? If you remember, note 1. We are told that the first one is a share for share exchange. So what is the shares acquired? Now, step 1, S shares acquired, P shares issued, multiplied by value of P shares. So what is S shares acquired? Susuke shares acquired. And remember, per the video that we have been doing, share for share gives rise to a share premium. How many shares did they acquire? 80% multiplied by the share capital. So what is the share capital? 80% of the share capital of this guy is 5,000 divided by what? 1. Don't forget the figure that is always here is important. All right. So how many will we get? So 0.8 out of 5,000 is 4,000 shares. 4,000 shares. Parent share issue. How many shares did he issue for the 4,000? How many shares did he issue for the 4,000? According to the question, by issuing 3 of per share for every 5. So you bought 4,000 shares for every 500 shares, right? Is it for every 5 rather? For every 5 out of the shares that you acquired, you are giving 3 of your own. So 4,000 divided by 5 multiplied by 3 gives you 2,400 shares. So you, the parent, you use 2,400 shares to acquire the 4,000 shares. And now, so you do 4,000 shares. What is the price you paid? The price you paid is, Papa's price is 5 cedis. Now watch this. It is 5 cedis. Good. However, if you check, the prices of their shares has always been 1. So if you want to know the one that will go to the stated capital, you can just multiply everything by 5. But if you want to know the one that will go to the stated capital, you will have 2,400 cedis. Don't forget, everything is in thousands already. Then the balance on it, 4, because total was 5. 4 by 4 will give you 9,600. And so the total purchase consideration will give you, so plus 2,400. That is 12,000 for this one. You could have also just multiplied 2,400 by 5, but you won't see the separation, because this one, the recordings has not been done. This one will be added to your stated capital, or your share capital, or your equity capital, whatever you call it. Then this one will be added to your share premium or other reserves. All right, so that is that. So take note of that so that you can get your marks well. This was not recorded, so you will be the one to do it. Now, purchase consideration, it was not only share for share. We were told that they issued loan notes. It says that, and they also issue 100 cedis 6% loan note for every 500 shares acquired. So the loan note, how do we do the loan note? So the first one was for share for share. Share for share. The second one is what? Loan note. How do we do the loan note? Now watch this. The loan note, we were told that 500 for every 500 shares acquired. The shares that were acquired was how many shares? 4,000 shares. So for every 500 shares acquired, you are issuing out a loan note that is 100%. 100 cedis, sorry, 100 cedis 6% loan note. So what would that also give me if I do what do we call it? 100 cedis for this 4,500, and I multiply it. What am I getting? This calculator is giving me a problem. Let me punch it well. So 4,000 divided by 5,000, that gives me 8. 8 by 100, that gives me 800. So here will give me 800. Now, so this is it, 800. Now watch this. The double entry for this one is to take it away from our investment. Okay, so usually this is it. This figure that he invested here. All right, so basically that is that. So usually take it out of the investment, the one that is supposed to be out of the investment. All right, then this one too, all right, is a loan note, and it would have been out of your investment, and you create a liability also for that. But they told us that this recording has been done. So that is that. So the total purchase consideration will be how much? 12,800. What do you do when you are calculating goodwill? You add NCI at acquisition, right? I hope you've not forgotten those things. NCI at acquisition. Which pen am I using? Yeah. So NCI at acquisition. You were given the NCI at acquisition because the question told you that the part that they did not buy, it's priced at 3.5. That is Suzuka. So if the total shares was 5,000 and they bought 4,000, it means the part that they didn't buy is what? 1,000. So it will be 20% of the 5,000 shares multiplied by what? 3.5. So 20% of the 5,000 shares, which will give me 1,000. And so this is it. All right. So that is that. Okay. So here, that is 1,000. Who is this? So 1,000 by 3.5, you get how much? 1,000 by 3.5 is 3,500. All right. So sorry, it's NCI at acquisition. See what a call can do. Then you less fair value of net asset at acquisition. I hope you're not forgetting that. Fair value of net assets at acquisition, which is your workings 2. Your workings 2. So how much would that be? You did your workings 2 at acquisition was 7,000. So you take away 7,000. And by that, you get your goodwill at acquisition. Goodwill at acquisition. We do this thing only for subsidiaries. We don't do it for associates. So if I have 12,800 plus 3,500 minus 7,000, that gives me 9,300. So my goodwill is 9,300. This is the goodwill at acquisition, but we prepare financial statements at the end of each period. So was there any impairment of the goodwill? I saw the last statement here that goodwill at the end of the year is 10%. All right, relating to the acquisition of Suzuka, and it was also determined that the investment in Obra also impaired by 200. Don't forget this. This is 200, not 200,000, because there are 300s at the top. So don't forget those things. So it means impairment here. Impairment. Okay. It's 10% of 9,300. So 10%, 9,300 is giving me 930. So that is that. This is a P&L figure. We will take it to P&L. Don't forget that. We are also meant to do P&L. So we will take it to the P&L. All right. So 9,300 minus 930. That is 8370. Sorry. Immediately you get this. We call this one goodwill carry down. Immediately you get this, you can go and start your balance sheet. So goodwill carry down. Don't waste time. Go and start your balance sheet. So you start. What is the name of the group? Papa Group. So statement of consolidated statement of financial position as at we are doing this thing in December 31, December 2020. All right, is that right? So that is that. Let me push myself somewhere here. All right, so you fix in your currency. Please, we do only one currency. We don't do 3 column and anything. All right, so you start goodwill, workings 3. You did it in your workings 3. And how much did you get? 8370, right? So 8370. Immediately you are done, go to your balance sheet. Okay, so here you will see the relationship, those ones that we are going to consolidate. You will see it in there, then you will start with it. So if you look at this one, check your non-current assets, so NCA. So you just say property, plants, oh, this pen, and equipment. Then you put into bracket, we are consolidating. So we have 25,500 plus 13,900. Then you come to your workings too, those things that were there at reporting. You have 50, so you have minus this. These are all part of property. These two, they are part of property. This is part of inventory. So you have 1,200 minus 1,200 plus 50. So quickly, you have to be fast. Where is my balance sheet? Oh my goodness. Here you are. So minus 1,200 plus 50. So quickly, you have to put them together. Don't delay. 25,500 plus 13,900 minus 1,002 plus 50. So I have 38,250. All right. So that is that. The investment, you have to check whether all your investments are gone or not. Is that okay? So always check whether the investments are gone. So if you check here, the investment alone in the form of shares was this, and also share for share payment. So it is overpasses this one. So this one will go off, right? That tells you that is it overpasses it. So sometimes when you do and you check, you realize there will be some balance. You keep the investment there, but this one there is an associate, so that thing will be replaced by investment in associate. And I think I saw Pape's investment. So look at this. Pape's investment include an available for sale, which increased in value by 300,000. So these are the things you are supposed to check, because if the investment that is here is this, and your purchase consideration that you are doing, you see that the purchase consideration, whatever it is, probably you have been told is the difference in the balance. It included something like this. You are told that this one was recorded. We are told that this one was also recorded. So when they say the thing includes it, what does it mean for you? So check where. But if you check this one, 5,400. So I always advise students, just do those things. Oh, internet. So we are looking at the investment that is there. Because you see that it is not jiving well. You have the thing exceeding it. Something is wrong. And they've told you that the figure that is there included some kind of investment. So investment in property that has gained value. So if you pick 5,400, you must take away the ones that they said they have recorded already. And when we were doing the purchase consideration, they told us that this one has been recorded already, which means that it is part of what is there. So it means you need to take away that 800, sorry. All right, so you need to take it out. Then there was an associate in the question. So you have to see investment in associate. How much was the associate? So we will do a working on investment in associate, because that one too is investment, because it is investment. Call it investment in associate. And we were told that when they were buying the associate, they bought it earlier. So it was 2.4 million. 2.4 million at a price of 1.5 each. That is 3,600. So it means we need to also take that one out. That is what has been there. So 3,600. So that is the two things that has been in their investment, because investment in associate is an investment. Then they also recorded the purchase consideration of the loan. It was already there. So those two are there. And so you get the difference of the investment. And we are told that this difference that will be left. So that will be 3,600 plus 800. That is 5,400. So if you 4,400, if you take 5,400 minus answer, that is 1,000. And so you are told that whatever 1,000 that was there, all right, includes this one, has increased during the year by 300. So plus 300. So you will have here an amount of what? 1,003. So that is that. You have to be very, very careful. That is that. All right. We will do investment in associate and it will come via a working. So let me put it in red here. So investment in associate. And of course, that will come via our working 6. So when we do working 6, we will bring that. All right. Because there was an investment in associate. All right. So that is that. So bear in mind, this is a fair value gain. It will go to our OCI, property. It should be part of our SPL as an income because it's a fair value gain. The things that are going to the SPL, I've already mentioned this one. This one too should go to SPL because it is depreciation, right? So where is those working so that I can label it? This one too will go to SPL. It should be part of the thing that should go to SPL when we are preparing the SPL. SPL. All right, so take note of that. Impairments, I've labeled it. All right, so after this one, what do you have in your, we have current assets. Current asset. Now, the current asset, what I have here is 12,500 plus 2,400. Is there any intra-group transaction we need to cancel out? Because there is PAP already. So the PAP, we need to take care of it. We saw a PAP. It's against your inventory of 400. So we need to do minus 400. Minus 400. It's affecting your inventory, and inventory is part of current asset, 400. So that is coming from your workings too. All right. But let's see if there is intra-group cancellation, if there was any intra-group cancellation. All right. So here, no, there's no intra-group cancellation. But we'll cancel this trade off when we are doing our P&L. In December, it so good to this guy. It's a PAP, but this PAP is not about a subsidiary. Is about Obra, which is an associate. We don't consolidate anything of the associate. So that is that. So let me add these ones two together, the current asset, all right, together. If I add the current asset minus 400, 12,000 minus 400, I have 14,500. 14,500. So basically, that is that. All right, just to confirm the figures again, 2,400. That's correct. So my asset side is done. So I should be able to total it and know my balancing figure as it were. All right. So that is that. So 12,000, 14,000 plus 1,003 plus 38,250 plus 8,370. It gives me 62,420. So that is the balancing figure I'm going to be looking for. All right. So now let's go to the equity side. We are doing balance sheet. Oh, this pen, my goodness me. Equity. So we have equity, we have stated capital, right? We have, of course, which you have 15 for the parent. So here only the parent. But remember, we did share for share exchange and we had how much we need to come and add to that. Stated capital 2,400. Remember. So that is that. So you add 2,400. So that gives you 17,400. Is that not it? Good. After stated capital, we have land revaluation. Land revaluation. Then we have other reserves. Other reserve. The other reserves is 500 plus the one that we done. The share premium is also a reserve. What is the share premium? 9,600. All right. Then we have also a revaluation reserve. Revaluation reserve for the land revaluation. So this is what, let's add it. Land revaluation reserve is 2,000. Revaluation reserve 2,000. Then this is 500 plus 9,600. That is 10,100. So you may see other people's solution whereby they added this one to this as well. They will do 15,000 plus 12,000. Straight away, you get it to balance, but it doesn't speak to principle. All right. It doesn't speak to principle. The next thing is retained earnings, which we are yet to do in our workings 5. So it will come by our workings 5. So we will know the equity people, then the NCI 2 will come. Right, this pen, which will come via our workings 4. And we will get our figure here. Then we will come to our NCL, which is the 20% loan note. 20% loan note. We are not told it is intragroup for us to cancel it out, so it will remain. Current liabilities is together. We have 10,000 plus 6,800. That is 16,800. So that is that. So let's see if we can balance it. So if you do this thing down, you should be fast with it, all right, and you'll be fine. All right, so let's do our workings 4. Workings 4. If you're able to do the balance sheet quickly, the P&L will also be very easy for you because that is the most easiest thing. So workings 4, we have NCI. How do we do it? NCI at acquisition. How much is the NCI at acquisition? You were given, you did it here. Fair value of NCI at acquisition, you had 3,500. Then NCI share of post acquisition. NCI share of post acquisition. NCI is 20%. And the post acquisition, how much did we have? Our workings 2 post acquisition. Machine is misbehaving. I think it's 950, right? Because of the internet. 950. So 20% of 950 is 190. And also their share, NCI share of impairment, which is 20%. The impairment, I had 930. So 0.2 by 930 is 186. So we have 3,500 plus 190 minus 186. That gives me 3,504. So this is my NCI carry down, and that is what I was waiting for. So it's what? 3,504. 3,504. So that is it. We are trying to get the figure that is here to balance it. All right, so that is that. It means that the next figure that I should be having in my retained earnings should end up with something 6. Other than that, it will not be balancing. So let's go to do our workings 5. And whenever there is an associate, do it alongside with the associate. So say workings 5, group retained earnings. Please, it is not called group reserve, it's group retained earnings. So do it alongside with your working 6, which is investment in. Oh, so if you have not done the investment in the associate, how did we total this one? Okay, so it means this side is not complete. So we have put this figure here. When we get the figure here, we will put it there. All right, that is interesting. It's good. So good. So investment in associates. All right. So when you put the parent retained earnings here, parent retained earnings, you come and put here purchase consideration. So what was the parent retained earnings? That is 12,900. Then what is the purchase consideration? We had it. It was 2.4 million multiplied by 1.5, and it was 3,600. I remember. And that is what we subtracted from the top. All right. Then when you come here, you do CI share of post acquisition. CI share of post acquisition, which is 80% multiplied by 950. So 80 of 950 is 760. Oh, this pen. Oh, let me see. Let me put on fan. Maybe my machine too is hot. Okay. So the same thing, you come and do CI share of post acquisition. The guy had 40%. So that is the associate investment. Let me write it well. This pen. So I want to write a CI share of post acquisition. That is 40% we have. But what is the post acquisition? Post acquisition is here. You find it in the P&L. This is the guy's P&L. And this is his money. All right, for the year. And you own 40% of this money. When did you start owning it? Per our group structure drawing, it is 6 months. You came together 6 months. So you do 6 months of that profit, then you find 40% of that. So that is the post acquisition. So you do 40% multiplied by 6 over 12 by 6,800. So that is that. So first, so 6, that is 0.5. 6 over 12 is 0.5 of 6,800. 3,400, then you are multiplying it by 0.40. That gives me 1,360. That is that. CI share of impairment. Impairment will be 80% multiplied by 930.
That gives 744. All right. So basically that is that. All right. Then, of course, we had the CI share of post acquisition for the associates. The same figure, you have it in your working 6. So that is 1,360. And in the question, we are told that there was another impairment. It says that it was also determined that the investment in Obra had impaired by 200. So impairment. So all the impairment. So here is the impairment on his investment. And that investment has been impaired by 200, which is affecting this profit. All right. So here it means that CI share of impairment is the whole thing of impairment. Impairment is an expenditure which will, it's a notional expenditure which will affect your profit. All right. So it means the profit that is coming here, we must charge 200 out of it. So this is what we're going to do here, 200 impairment. All right. So basically, this is that. All right. So that is that. Any other thing left for us to do? We were told that there was an investment increase, right? The investment increase that we saw, where was it? It included, and that thing went up. So fair value change of investment. Change in fair value of available for sale. And that is 300. All right, so that is that. As far as the associate is concerned, there was also a PAP on it, right? When they sold to them, this one, where is it? Where is it? They made a sale. You read it before. Yeah, he sold to Obra. All right. So here you will do 40% of the PAP because you own 40%. So CI share of PAP will be 40% multiplied by into bracket. The PAP is what? 25% of 125, right? So we have 25 of 125. Everything is still in stock, right? As per the question here, that they've not sold anything. So 2,000. That is it. And that is between him and, so that everything is between him. So it's like PAP, not CI share. It's just PAP, sorry. So 25, 125 multiplied by for how much was that? 2,000. All right. So basically that is that. So his portion, so this is what I wanted to explain. So his portion, everything that they did, the trade between them is this, but his portion, so you've done this, then you do multiply by 40%, what I was trying to bring in front of you, but I want you to know the PAP, then you do the 40%, because everything that is happening in there is 40% of it, except for the impairment. The impairment, they were so specific that it is the investment. Listen to the English. It was determined that the investment in Obra was impaired by his investment in Obra. All right. If it was the entire Obra as that had impaired, we would have also done 40% of that thing. All right. So that is that. So this one will give me 160. All right. So basically, that is that. So this will give me my cost of investment. The PAP2 is here. PAP associate. PAP associate. It should come here. So you can also say, you can record 25 over 125, 2,000, like that. You have to find a parent share of that, of the transaction. All right. So we found out that that thing was 160. Is that not it? All right. So ladies and gentlemen, this is it. What will be the figure here? The figure here will be 36,000. And I think there is a question about it. So Obra owed 350. Obra is an associate. So it means that this figure is inside the receivables, which is part of the current asset. But because Obra is an associate, we don't consolidate, meaning that we won't subtract from it. It has to still be in our receivable. So our figure that is there, I think, yeah, this one is okay. But when we finish calculating this thing, I think this figure will change. All right. So let's bring in the correct figure for the investment. We have 3,600 plus 1,360 minus 200, the impairment minus 160. All right. So in all, this is 4,600. So you see, all these things are P&L items. So if you want, you could have just done a summary of this and slot it here rather than bringing CI share. How you see everything is here. So you see everything is there. So you could have just done also that. So we are 1,360 minus 360. That means here is 1,000. All right. So we will pick this figure to our P&L when we are doing the P&L. So that is that. Okay. So 4,600 is our investment in associates. So this figure, we will add 4,600 to it. So 4,600. So that 4,600 plus 62,420. So our final answer actually should be 67,020. All right, this is our final answer. Okay, so now let's work this side and come and also drop it in there. All right, is there everything? Have we captured everything? Have we captured everything? All right, so I have 12,900 plus 760 minus 744 plus 1,360 minus 200 plus the increase in the fair value plus minus 160. All right. That is giving me 14,216. 14,216. I hope we have captured everything that we wouldn't have to come back. So 14,216. So that is what I have here, 14,216. So that 14,216 plus 10,100 plus 2,000 plus 17,400. That gives me 43,716 plus NCI. That is 47,220 plus 3,000 plus 16,800. That gives me 67,020. So this is the balancing, and that is it for your balance sheet. All right. So easy peasy. That is that. All right. So now let's do the P&L aspect, which is very straightforward. We have Papa's group, consolidated. Be careful of this, because if this were to be an associate, you would have subtracted it from the current asset. But this a subsidiary, would have subtracted it from the current asset. But this is an associate. So associate, you don't consolidate. So it doesn't mean go and subtract. It's not an intra-group. All right. It's not an intra-group. Take note of that. So if the associate is owing you, you will take the money. All right. It is part of the debt the associate is owing you. All right. But somebody can make the argument that the money is coming from the same transaction of the sales that they did. I keep looking down. Let me look up because I'm here. So the money is coming from the sales that they did in between themselves, and they are owing the money in between themselves. All right. But this is an associate. Associate, when you sell to an associate, the only portion is the portion that you own, the 40%. So if you made a profit, so that is that. You have to deal with it. Okay, that is why we take away, because as it's like you selling to your son kind of thing. All right. In that case, you don't need to consolidate those portions. All right. So basically, that is that. So as for the PAP, do I still have my template? No, I don't have it. I would have shown you, all right, that how we go about it. So if and because we are doing this because the parent is the one that sold to the associates. Okay. So basically, so 40% of that. But if an associate is owing a parent, it is not an intra-group transaction. All right. So in effect, it must be there. In effect, it must be there because it is an associate. All right. That is that. So consolidated statement of profit and loss. And OCI. Please write it in full. Other comprehensive income for the year ended 31st December 2022. Underline it and put your currency sign. So you have your revenue, cost of sales. All right. So let's go upstairs. You know how we do it. Here will be what? 92,500 plus 4/12 multiplied by 45,000 minus the intra-group that they did, intra-group sales. Where is it? Sales from, yeah, intra-group sales is 12 million throughout the year, but they came together 4 months. So just 4/12 multiplied by that 12, which is 4, because this is 4,000, right? And this one to be what? The cost of sales. The cost of sales, cost of sales is 7,500 plus into bracket 4/12
by 36,000 minus this one, 4 over 12 of the 12,000. Okay. Minus the 50, the excess. It should have actually been plus if it were to be a positive, but this is an excess, so it will be minus. All right, minus. I just want to move this figure, the zeros here. Let me see if I can move. No. I can't move this. So let me come here with it. So that is that. And plus the PAP, we had PAP of 400, right? In our workings too, didn't we? So PAP of 400 in our workings too. So let's total this one. Now let me use this calculator. This is better. So you have 4 over 12 by 45,000. That's 15,000 minus this side there is 4,000. So minus 4,000. All right, plus 92,500. That is 103,500. What about this side? This side is giving me 4 over 12 times 36,000. That is 12,000 minus 50 plus 400. The 400 is coming from our workings too, remember? Plus 70,500. That is 82,850. All right. So that is what we have. Minus 103,500. That is 2650, right? Okay, so this will be our gross profit. So basically, this is it. Then we continue with the administrative expenses. That one starts with distribution. But I will advise that in the exam, try and, because this is P&L, if you get it wrong, you don't know. So always try and go punch the figure twice, all right, to see. So for example, if I punch this one twice, I still have this one correct. Then I'll punch it again because of the nature of it. Always try and do it again, all right. So here too, you will see. So if I'm, let me see, 7,500 into bracket 4 over 36,000. Then this one is 4,000. So minus 4,000. Then minus 50 plus 40. Hey, I'm having 78,850. Then what did I have here? You see, just in case. I mean, this is just the figures part, all right? But if you, the good news is that in exam, if you do this thing correctly and here is wrong, you'll be marked correct anyway. All right, yes, you'll be marked correct because the examiner sees. And this one will be what? 2,500. Let me just make sure I point the correct thing. 4 over 12 multiplied by 1,002. So 4 over 12 by 1,002. I just punched 12,000. 1,002. 4 over 12,002. That is 400 plus 2,500. That's 2,900. So it means here should change, right? 103,500 minus 78,850. It should be 24,650. So that is that. Then we have admin. Admin is 5,500 plus 4 over 12 of 2,400. 4 over 12, 2,400 is 800 plus 5,500, 6,300. And that should give me profit before interest and tax. So let me add plus 2,900 or minus 24,650. But I think there was goodwill impairment, and goodwill impairment is supposed to be added to admin. So how much was the goodwill impairment? 930, right? Yeah, I remember. It was 930. Yes, this is it. So add it, or you can just do this and come under and do so. But let's add it for correct reporting. 930. So this one will be 6,300 plus 930, right? So that is 7230. 7230. So 7230 plus 2,900, all minus 24,650. That is 14,520. All right, so this is it. Then you add investment in associates. In associate, the income that you get investing in the associate. And that thing is in the working six part. You check the P&L aspect of the work. You see, I did it here. So all these are the P&L aspect. And those ones are the same thing that goes to your retained earnings. So that is 1,000. All right. Investment in associate. So you can direct the person to working six and write here 1,000 is positive. Then there was investment increase. In the available for sale. All right, available for sale. So it is said that if you have done IFRS 5, NCA held non-current asset held available for sale is treated in your books as current asset. Okay, so and if the value had changed, you will change it there. So it's actually a realized amount. It's not like it's an unrealized amount. So it's a realized amount. If it's an unrealized amount, then it will go to OCI. But this is a realized amount. So where was it? It was somewhere. This one was already inside the books. Which one? Papa's investment includes some available for sale, which has increased in value by 300. So it is an increase in value. And if it is in your retained earnings, then it means that it should also be part of here. So investment increase is a fair value increase in investment. So that's what we call it. Fair value change. In investment. All right. And how much is that? It was 300. So that is that. So these are your investment incomes. Then you less finance cost. The figure that you'll be getting is profit before tax. So profits before tax. Then you tax so that you can get the profit after tax. So what is the finance costs? Finance costs is 100. I think there is nothing on it, straight 100. It's a subtraction of 100. So let's go. 14,520 plus 1,000 plus 300 minus 100. 15,720. Then tax. Tax is 3,900 plus 4/12 of 1,005. So 4/12 of 1,005 is 500 plus 3,900, 4,400. Profit after tax, 11,320. OCI, so you bring the revaluation gain on the land. It is only for the parent. You could see clearly because it is only here. It's 500. So total comprehensive income will be 11,720. Then you do your attribution. How do you attribute this? So this will be attributable to 1, shareholders of parents, and 2, the NCI. You are sharing the profit first, this one first, but the NCI, you always do the NCI on first. Go and visit your workings for. You will see the part that comes here. Where is our workings for? Workings for. Yes, this is it. So the only part that belongs to them is only these two things. The difference is 4. So 4, only 4. So you come here and you write 4. 4. All right. So since this one belongs to this one, so you are sharing the earnings first. So 320 you had minus 4. That is 11,3. Oh, this pen can disgrace. 11,324. Right? Does it give me my? No. No. It is 11,320 minus 4. It's 11,316. So that when you total, you have your 11,320. Then you share the OCI part 2. But that one, it looks as if it was for only the parents. So shareholders of parents. But if the NCI was part, you do NCI 20% of that. Okay. So this one, everything is for the parents. So you get your 11,700. Is it 11,700 or 11,820? Commas. 11,820. 11,820. So, ladies and gentlemen, this is everything. All right. So let's check the answer your lecturer gave. All right. I think there's a slight difference. They copied wrongly because I see something here. Senior's profit. The question had no senior in it. Is there any senior in this question? There is no senior in the question. And that tells you that a lot of things are wrong in here. Okay, I think here they had it. The share, they didn't subtract the provision for unrealized profit from it. It's something they are meant to subtract because inside the profit there is unrealized. It's something they are meant to subtract to have 1,000. So these are things you need to check. All right. Apart from that, what else? The retained earnings. There are a lot of things that didn't come. So you will have to check that. All right. Here is correct. Balance sheet. Yeah, this one too is correct. I think we had same, right? Balance sheet. Yeah. They've done well with this. This is also good. This is good. This is good. This is good. I think up to this point, it is okay. The current asset, what did they do with current asset? Nothing is supposed to be done apart from minus 400. So where is it? Note what? They took away the 350, which shouldn't be. You can't take away the 350 because it is. We don't consolidate an associate. You don't do intra-group minus there. This is actually not intra-group balance. No, it is not. So we don't consolidate associate. So it cannot be intra-group. I think apart from that, everything is fine. So please, this is your real correct answer. I think the question to the person who copied the question for this video is good. I'm doing it for my UG Legon level 400 students. All right. So yeah, I think apart from that, so you have your correct answer here. You can deal with that. All right. So thank you and see you in another example.